Coming up on Market to Market. Farmland values in the heart of the Corn Belt soar to all-time highs. The Senate Agriculture Committee tries to find billions of dollars missing from MF Global. And in the wake of record flooding, rural insurance premiums threaten to rise higher than the rivers. Those stories and market analysis with Darren Newsom next.
Funding for Market to Market is provided by Pioneer Hybrid, working with growers to help put the right product in each field. Pioneer, science with service, delivering success. This is the Friday, December 16 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mark Pearson. Heading into the crucial holiday shopping season, U.S. consumers appear to be loosening their purse strings. According to the Commerce Department, retail sales rose 0.2% in November, marking the sixth consecutive monthly gain. Much of the increase was driven by strong auto sales as Chrysler, Ford, Nissan, and Hyundai all reported double-digit improvements. Retailers who could make up to 40% of their annual revenue during the holiday shopping season enjoyed a record $52.4 billion in sales over the Thanksgiving weekend. And that prompted some economists to estimate the U.S. economy will grow by about 4% in the fourth quarter, which would be the fastest pace in 18 months. Consumers may have to cut back on spending, though, if Congress doesn't extend emergency unemployment benefits and a payroll tax cut due to expire on New Year's Eve. The Social Security tax alone boosted take-home pay for the average U.S. household by about $1,000 this year. But even as policymakers try to put more money in consumers' pockets, other lawmakers were busy this week trying to locate more than $1 billion of investor funds missing from the now-defunct brokerage firm MF Global. Last week, the embattled former CEO of MF Global, John Corzine, appeared before the House Agriculture Committee. This week, he continued his congressional tour, testifying before the Senate Agriculture Committee about $1.2 billion of missing investor funds.
Where is the money from funds that were supposed to be kept separate? Customer money.
To trace missing funds, it will be necessary to analyze and reconcile multiple hundreds of pages of daily transactions, multiple bank statements from many countries, and to review account records of more than 38,000 customers. While I was at MF Global, I would not have seen those records, and I have no access to them now.
Corzine, a former Democratic U.S. Senator and governor of New Jersey, is accused of authorizing the illegal transfer of funds from investor accounts to shore up company losses. According to federal laws that have been on the books for 75 years, brokerages are required to keep customer funds separate from those belonging to the company. Investment firms are permitted to borrow from customer accounts temporarily, but only within strict parameters.
I never directed anyone at MF Global to misuse customer funds. I never intended to, and as far as I'm concerned, I never gave instructions that anybody could misconstrue.
Despite Corzine's testimony, he was unaware of any commingling of funds. The executive chairman of CME Group, owners of the Chicago Board of Trade, told a different story.
A CME auditor also participated in a phone call with senior MF Global employees, wherein one employee indicated that Mr. Corzine knew about the loans that had been made from the customer segregated accounts.
In October, after MF Global announced it was in financial trouble and was rumored to be in the process of selling, auditors from both the CME Group and the Commodity Futures Trading Commission, or CFTC, paid the company an unannounced visit. While initial reports indicated things seemed to be in order, a $900 million accounting error was eventually discovered. On October 31, MF Global collapsed. In the wake of the eighth largest bankruptcy in U.S. history, nearly 40,000 futures accounts were frozen, locking up almost $5.5 billion. USDA's World Supply and Demand Report was released not long after the firm was declared insolvent, leaving many futures investors with the only choice of liquidating their positions and taking a loss. Among those on the losing side were several U.S. farmers and ranchers. On Thursday, Corzine was again in front of a congressional committee, repeating he had no knowledge of an illegal transfer of funds.
But once again, let me be clear, I never gave any instruction to misuse customer funds. I never intended anyone at MF Global to misuse customer funds, and I don't believe that anything I said could reasonably have been interpreted as an instruction to misuse customer funds.
If you did anything wrong, the criminal investigators will find that. I won't. I'm trying to find out, and my concern is the things that you were doing, that as you hit by your own statement was nobody intended to misuse anything. Now, again, I'm taking you at your word on that. The things you were doing are relatively common in the industry. So you were doing, at the time, at least as I read it, pretty much what everybody else is doing. I guess my question, which I know you won't be able to answer, who else is doing this and how much is at stake?
We got rainmakers out in the dusty, barren sand hills of New Mexico. They drive around in pickup trucks with 55-gallon drums brought out of the oil field, cleaned up, and pour a few chemicals in, light them up, create rain. It's not much different than what they do on Wall Street. Thank you, sir.
Joining Corzine in the hot seat was MF Global's Chief Operating Officer, Bradley Abelow.
I know this committee is interested in finding out what amount of segregated client funds went missing in the final days, how it happened, and where those funds are, and what might eventually be returned to the firm's clients. I am deeply troubled by the fact that customer funds are missing, and I can assure you that I share your interest and the public's interest in finding out exactly what happened. At this time, however, I do not know the answers to those questions.
CFTC officials say account holders will be reimbursed for more than 70 cents on the dollar. The whereabouts of the missing $1.2 billion, however, remains a mystery. The Agriculture Department estimated this week that U.S. net farm income will amount to $100.9 billion this year. That's up 28% from last year, and it's 50% higher than the 10-year average. The values of farm sector assets and equity are forecast to rise in 2011, while farm debt is predicted to decline. Farm sector assets, including land and buildings, are expected to appreciate by nearly 7% this year, a respectable increase nationally, but nothing compared to parts of the Corn Belt, where land values are soaring to record highs.
We've been on, pretty much a straight upward trend. There's been a couple of bumps. And then starting in about 2006, we've just been almost straight up.
Iowa State University Extension this week released its annual land survey. Started in 1941, the study provides information on general land value trends, geographical land price relationships, and factors influencing the Iowa land market.
What we found overall was a 32.5% increase. This is the largest increase that we've ever recorded. The previous high was in 1973, and that was just a little over 31%.
Earlier this month, a 74-acre tract of land in northwest Iowa sold for $20,000 an acre. The previous record was set in October when a 120-acre parcel went for $16,750 per acre. Analysts cite strong prices for hogs and cattle in livestock-heavy northwest Iowa as one of the reasons for surging values in that part of the state.
It was a tremendous sale. I think the biggest thing that we always have to remember is that there's always something behind every sale like that. Good quote I heard was that economics gets people to the auctions and then emotions set the price.
Land values are soaring throughout the Midwest with double-digit percentage increases last year in Illinois, Indiana, Kansas, and Minnesota. Nebraska economists reported a 40% increase. Experts say rural land values began to rise a few years ago in response to demand for corn. Now, increasing prices for wheat, soybeans, and other crops are supporting the upward trend. The dismal performance of the stock market is attracting people to buy farmland. One Iowa farmer recently quipped he'd rather own farmland right now than gold. The ISU survey reports farmers make up the majority of buyers of Iowa land. It revealed 74% of farmland purchases were by current producers, 22% were by investors, and 3% were by new farmers.
If I pay 70, 80, 90% down, it's going to pay for it. It'll cash flow. Is it a good investment? Is it a good buy? Well, that's a different question. With the young people, it makes it very difficult for them. There's a song with we want it all and we want it now. Well, it isn't going to happen with land. It's always been difficult, and it always takes time for the young people. They need to build up capital.
While times appear to be good, the rapid rise in agricultural land prices has some worried. Plus, input costs have more than doubled in recent years, and commodity prices can be extremely volatile, reminding some of the disastrous economic conditions endured during the 1980s farm crisis. During that time, overextended farmers lost their land, but bankers say most farmers today are much less debt-ridden than they were then because of higher crop prices. Still, some remain concerned.
I think we need to be watchful. Concerned, it depends on how you're defining that term. We can be paralyzed pessimists or foolish optimists or positive realists. And I think we need to be positive realists that a lot of the increase in the land values, it's fundamentals. And, we see record low interest rates. We've seen commodity prices that, even though they're softening, they're still strong. Export markets are strong. There are just not a lot of people that want to sell the ground they have, and a lot of people that want to buy it.
Next, the Market to Market Report.
Mother Nature destroyed the record for U.S. weather disasters this year as losses in a dozen calamities exceeded the $1 billion mark. Tornadoes accounted for half of the record-breaking disasters as a steady stream of lethal twisters roared across dozens of states, claiming the lives of more than 1,000 people and inflicting nearly $28 billion in damages. Flooding caused significant losses along the Mississippi and Missouri rivers, and when combined with losses due to record flooding along the Mouse River in Minot, North Dakota, America's swollen waterways racked up more than $6 billion in damages. Now that the waters have receded, insurance premiums in some watersheds threaten to rise higher than the rivers. Midwestern farmers still drying out their formerly flooded farmland are likely to get hit with another punch: steep increases in crop insurance premiums. The reason? Much of the damage from last summer's epic flooding still has not been repaired. The Missouri River rose to its highest levels in recorded history this past year, following the release of massive amounts of water from upstream dams and reservoirs in Montana, Nebraska, and the Dakotas.
Oh, wow. Unbelievable. Look at that.
Weakened levees were overtaken, flooding thousands of acres, ruining fields, homes, and infrastructure. The U.S. Department of Agriculture's Risk Management Agency said this week $114 million in claims have been paid so far for flooding damage on the 436,000 acres downstream from the Gavins Point Dam on the Nebraska-South Dakota border. The Mississippi River was not immune to the devastation. On the Birds Point levee south of St. Louis, the U.S. Army Corps of Engineers blew a hole in a levee, attempting to save the tiny town of Cairo, Illinois. Thousands of acres were flooded as a result of the Corps' decision. One Missouri producer watched helplessly as 8,000 acres of his farm succumbed to floodwaters. He received $1.5 million in federally subsidized crop insurance benefits, but his premium increased five-fold on a recently planted wheat crop, because USDA now considers his land to be high risk. Officials with the USDA's Risk Management Agency began warning farmers of potential rate increases over the summer because they didn't want them to be shocked when the 2012 rates were announced. It can be 2 to 3 times more expensive to insure farmland behind damaged levees than those where repairs have been made. The Corps estimates it will cost more than $2 billion to repair damage this year's flooding inflicted on levees, dams, and riverbanks. With a funding bill stalled in Congress, the Corps has been focusing its limited resources on fixing vital levees, protecting communities and facilities such as water treatment plants. Farmers also must restore their soil to pre-flood conditions to get their insurance rates back down. Flooding often cuts massive ruts in the land, washes away topsoil, and inundates fields with sand. The levee at Bird's Point was 62.5 feet high before the explosion. Generally, levees must be restored to their pre-flooding condition, but in the case of Bird's Point, farmers won't face big premium increases if the Corps gets it back up to 55 feet before spring planting. Grain prices were pressured this week by a stronger dollar. For the week, March wheat declined 12 cents, while the March corn contract gave up more than a dime. Soybeans broke ranks with the coarse grains as the January contract gained 23 cents, while nearby meal prices advanced $13.40 per ton. In the softs, the March cotton contract lost more than $4 per hundred. In the dairy market, January Class 3 milk futures were off a nickel, while the February contract moved 20 cents higher. In livestock, the February fed cattle contract gained 5 cents. Nearby feeders rose nearly a dollar, and the February lean hog contract lost $3.27. In the currency markets, the euro lost 345 basis points against the dollar. Crude oil declined $5.88 per barrel, and COMEX gold tumbled $119 per ounce for the week. And the Goldman Sachs Commodity Index lost more than 30 points to settle at 618 even. Well, here now to lend us his insight on these and other trends, one of our regular market analysts, Darren Newsom. Darren, a lot to talk about this week.
Oh, there really is.
Some of the air coming out of the commodities, $119 per ounce decline in gold prices. People are looking at that, saying the bloom's coming off commodities. Obviously, the huge move in the dollar against the euro is going to be another factor we're going to have to deal with going forward.
Yeah, that last chart you showed of the CRB index really tells the story. There's a lot of money coming out of commodities right now, and as you pointed out, much of it is due to what we're seeing in the dollar. Dollar's had a nice rally here over the last couple months. It's pushing up against some technical resistance, up around that 80.7, something like that, somewhere in there. So what we're seeing is money coming out of commodities into the dollar. It's hard to call the dollar a safe haven play, but it certainly seems to be, with no real fresh news in commodities in general, that's where the money's wanting to flow. Money wanting to move there until we start to get some fundamental news in the grains and energies. As you said, in gold, there's really nothing in there. Until we start to get some news in there, they're just going to back out of commodities for a while.
And we have a viewer in Canada named Phil, and he says, when is this? When are those non-commercials? All those big funds? When are they going to come rolling back into the commodity markets, and where have they taken their ball game? Are they buying dollars?
I think so. I think that's where the money's...
Spanish debt?
Yeah, it could be going anywhere right now. All I know is, with what all we're seeing that's going on in the commodity industry right now, the huge questions about, how safe is it? What's it going to be long term? We're seeing money just, again, move out. There's no fresh news to drive. There's no reason for these traders to be getting excited about commodities right now. Now, when could this change gears? I'm guessing it's probably going to be closer to the spring. We're going to have to fight our way through this winter with really no news whatsoever. Once we get closer to the spring, I do think interest starts to come back into the commodity markets, into energies, into grains, and that could start to bring the money with it again.
All right, well, let's talk some turkey here. Let's talk specifics. Let's start with the wheat market. And again, as you look at wheat and you look at the world situation, plenty of wheat everywhere. Right. There's a lot of crummy wheat out there.
There is. We've been fighting this bearish global supply and demand situation for wheat for years now, and it just doesn't go away. And it doesn't matter if the U.S. had a poor crop, poor quality crop. But I think maybe later on in the 2011-12 marketing year, let's say we get into the springtime, that April, May, June time frame, we might actually start to see some of that fundamental bearishness come out of the market, because there is a lot of bad wheat out there, and you can only sell low-quality wheat for so long. So there may be a push later on. Right now, though, short term, I kind of like the wheat market. It's oversold. It's been beaten up. Non-commercial traders are holding a very large net short futures position. Quiet time of year, they could look to step back in, cover some of those positions, and with no sellers out there, might see a little bit of a spark in the wheat market.
Okay, so we have to wait for that to occur before we make more sales. Is that your thinking?
Yeah, I would not make any sales where we are right now. We're down near some technical support. If it breaks through, we may have to change our tune a bit. But if we look at the Chicago market, Kansas City, down near some levels that really need to hold, and I think we're going to be able to build out of here for a while before we make our next round of sales.
All right, let's talk about the corn market, which really gets hit more with the poor quality wheat out there. We saw Australia selling some of their poor quality wheat as a feed into China and other countries. So that's going to weigh on the corn market and corn demand. And we've already had a lot of pressure on this corn market. And yet our stocks are still very tight.
They are, and I think that's the big picture. You know, it seems like the market's gotten used to talking about, you know, a tight domestic supply and demand situation, a very tight world supply and demand situation. It's just not fresh news, and so for that reason, we're seeing the futures market drift back down. March seems to be targeting its long-term technical price target of about 5.5 to, and I think it's right around 580, 585 right now. So we've got a little room to come down. But again, as we get closer to the spring, I think we're going to see this market really heat up again. I think corn's probably going to lead the way because the global supply and demand situation is as tight as it's been since 1973-74. Not much room for error when we start talking about the weather and planting and the growing season next year.
And that'll be our catalyst maybe for some stronger prices.
Right.
How much lower can we go, Darren, at the rate we're going?
I really don't think we're going to see the nearby contract go much below 5.5, and I don't think we're going to see a lot of pressure on the new crop December contract as well. Maybe 15, 20, 25 cents down, worst case scenario in the new crop Dees. At that point, I think the Dees is going to start to get some interest because of all the questions heading into the 12-13 marketing year.
Last couple of years, it's paid for farmers to hold on to grain and sell it in the summer. I mean, we saw it this year in 2011, 2010. Is that kind of the ballgame that's being played? Because everywhere I go, every group I talk to, very few people have sold anything.
Yeah, and that's kind of a problem that the market's facing right now. And you know, we go back 4 to 6 weeks ago, the carry in the future spreads was very weak. There was a lot of anticipation for a strong market later in the spring and early summer. But what's happened is that carry has strengthened over the last few weeks because the commercial side of the market now realizes all that grain that wasn't being sold that's sitting tight in a bin is going to come on the market later. So there are going to be supplies at the time when they thought it was going to be tight. So that could keep a lid on the type of rally that we see this spring. Normally we rally about 20-25%, you know, as far as prices go. So that could keep a lid, kind of keep us held in check a bit.
All right, and let's talk about the soybean market. And really underpinning all this, and we had a tweet from one of our viewers asked the same question that I was thinking about, and that is the impact of the MF Global situation. I mean, how much has that played into these prices?
You know, you can make an argument that it's been one of the reasons why we've seen all this liquidation coming into market. And we have seen all three grains see a great deal of non-commercial selling. A week ago, not this Friday, but a week ago, we saw that the soybean net long futures position was only about 8,500 contracts, the smallest it's been since early 2010. Real threat to going into the negative numbers here this week. But that money started to come back in. Was that an action? Was that in reaction to MF Global, or was it seasonal? I think it's a combination of both. There just isn't that kind of news to keep everybody interested. We've got dollar doing things. I think MF Global is affecting the markets. It is affecting the flow of investment money in, but will it be long term? I don't think so. I think the money is going to come back.
Let's quickly move on to the bean market there. And what are your thoughts there? A little bit of a pullback this week in beans, and really these are attractive prices.
They are. Again, I wouldn't really want to make any sales in soybeans right now. We tested support near 1070. We held that support on the January contract. It's getting ready to go into delivery, so the focus is going to shift to March. But either way, it looks like the bean market is set to rally. Low volatility. It could become attractive to traders again. We saw them building, starting to rebuild their net long futures position this week. That could provide some support, push up through some resistance, maybe get a decent rally in here over the next few weeks.
All right, maybe wait into January for that rally to occur. I mean, I think that's holding on a lot of people right now.
Yeah, you know, I would actually be willing to sit back quite a while on soybeans and on corn and wheat for that matter, because, you know, seasonally, we see corn and soybeans push into June, July before they top out. Be very cautious with them. But certainly I think we can give this market some room. See if we don't start to build some interest again.
Real quick on the cotton market, a pullback this week. A lot of eyes are watching what's going on with cotton as kind of an indicator of what's going on globally, and it hasn't been too positive.
No, it hasn't. And one of the things that we've seen happen in the cotton market is that bullish future spreads showing a bullish commercial outlook starting to back down. Now, again, like the other markets, maybe we can see that start to build in again, start to build some support back into those nearby cotton contracts, but more importantly out to the new crop contracts.
Okay, let's get to a more buoyant area, and that's been livestock. Ever since the corn market's been dropping, we've seen feeders take this big jump. We've got a bred cow and a bred heifer market that's on fire. What's your outlook for fed cattle?
Fed cattle, you know, I still think the cash market wants to stay strong. Again, I look at the future spreads, and it looks a little bit bearish to me. But we're able to hold on to these cash markets. You know, the Fed market's strong, live market's strong. I think we want to stay high for a little while. Now, if we start to see some shifting going on in the other commodities, that could cause some problems. But right now, there's really no signs of weakness coming in the cattle market, say, as opposed to what we're seeing sometimes over in the hogs. So I think we're going to see the cattle market stay relatively well supported.
Okay, and the calf market's strong too?
I think so, because I think we're going to be looking for some replacements. Now, the problem in the cow-calf area is that we've got such high feed, high hay costs going into, say, the southern plains and so on. That's actually going to probably help cattle, cow, calf markets elsewhere. But overall, that market you're going to have to watch very closely to see if the replacement demand stays strong.
All right, hay has been crazy. It's
has
a
been.
commodity we don't follow in the show. There's no futures market, but it's been huge, and the differential's been huge. Real quick, hog market, what do you see there?
Hog market, I'm a little concerned about because it's getting a bit more volatile than the cattle market. You're seeing some wide swings, which is normal for the hogs. But if cash starts to go away, if cash support starts to go away, that market could come down really quickly.
All right, and so do you want to hedge off in here or not?
I think if we get kind of a riding the coattails of cattle rally, I think it is going to be an opportunity to get some hedges in. You know, seasonally, not a real strong time to be doing that. But if we can get, say, the first half of 2012, get a portion of those hogs, the portion of that production covered, I think it's going to be a pretty good opportunity for us here in the next couple of weeks.
All right. Well, Darren, we'll see what transpires. Good chance to cover some feed needs, though, with this breaking corn.
I think so. Yeah, it's given us an opportunity.
All right. Darren Newsom, thank you so much. That'll wrap up this edition of Market to Market. Now, if you'd like more information from Darren on what he has to say about these volatile markets, why not head to the Market Plus page on our website? You'll find expanded market analysis, audio podcasts, streaming video of our program, and links to our Twitter feed and our Facebook page. And by the way, it's all free at the Market website. Of course, you want to join us again next week when we'll examine the impact of record drought on Texas cattle. Until then, thanks for watching. I'm Mark Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Pioneer Hybrid, working with growers to help put the right product in each field. Pioneer, science with service, delivering success.